Hey everyone, and welcome to the Creative Financing Podcast. I'm Nicole Kamanjian. I'm here with Cody Richard and the host of this show, Jeff Rappaport. This is episode 211, and today we're going to continue with hybrid interest rate. This is part 3. While listening to this episode, if you guys have questions, please head over to our Facebook group. If you're not part of the community, just search the Creative Financing Podcast in Facebook and ask to join. We're going to start having a live session once a month on the second, is it the second or the third Thursday? Second Thursday of the month. So please join that group and you'll be able to learn different aspects of investing. If you're watching this on YouTube, please feel free to ask questions in the comments below. If you're getting any value from this episode, please like, share, and subscribe to the show. It lets us know that you're learning from our content, and it motivates us to continue making episodes for you guys. We also want your feedback, so please please rate and review us wherever you listen.
Awesome. All right, so we're going to move into yet another example so I can show you why the use of this hybrid kind of interest rate can really benefit you. And if this is still a little bit confusing to you, don't worry about it. This is, like I said, just another tool. And if you don't quite grasp it, don't worry about it. It doesn't have to be a tool that you use. But I feel like the more you understand, the more you're able to use it, it'll give you some more options. So,
or even if you come across something where you're like, okay, this may be a use case, come back and listen to the episode.
That's
Give
right.
another listen when it applies, and then you can put it into action.
Yep. Come to our Facebook group and post it there. We'll help you with it. All right, Cody. So let's go. Let's map out this new example, and that way we can figure some stuff out. This is where I find I use the hybrid interest rate on all kinds of deals, but this is where I really find it to come in handy. So we're going to look at a duplex. And let's say that the duplex has an ARV of 380.
Okay.
And let's say that the seller wants 385. Unheard of, especially these days, right?
Well, that doesn't sound like that duplex is in Salt Lake, because that's cheap.
It would not be, no. Let's say it still needs a little bit of work. Let's say 10 grand and some cosmetics. And let's say right now it gets current rents of $2,300 a month.
All right.
Nicole, is this a deal?
I was just going to try to calculate the 1% rule.
Well, go ahead. How long
So
does it take
they're
you?
asking 385, right?
Yep.
Like 0.6, 0.7%, or 6, or 0.6, 0.7% rule.
Yeah, somewhere in there. Pretty normal, all right? I mean, certainly something that you're going to see more often than not right now. Cody, you're an investor. Is this a deal for you?
Not for me. If I was more active in buy and hold right now, yeah, I think it could be a deal. But as primarily wholesale, I don't know that there's enough room for me here.
Well, let's break this down, and then let's look at how maybe we can use the hybrid interest rate to help make it a deal. Okay.
I guess I should say with cash, it's not a deal for me.
Definitely not a deal with cash. So let's create, you know how I like to do this, right, Cody? I'd like to work backwards. So first, let's take the rents. 2,300 a month and times it by 12.
Okay.
And that's going to give us $27,600. So really what that means, if that's, even in the vicinity of market rate rents, maybe you could rent this for a little more if it's a little nicer. Maybe the rents are a little bit on the low side, but I'm taking, if these are within market rate rents, that's what I'm taking. I'm taking what it's getting now, not what it potentially could get. Okay. And let's take what the expenses are. And so let's look at taxes and insurance. Just put that as one. I've combined them.
Okay.
That's 4,300.
And these are all annual.
Yep. Utilities, 1,800. Maintenance, 1,800. Repairs, 1,500. And there's no management. But if you were going to use management, you would have to add that in, right? So let's add up all the expenses. And so if we have 4,300, 1,800, 1,800, 1,500.
9,400.
Is that right?
I took a shot at it, hoping I wouldn't have to erase it.
Yeah, I think you're right. 9,400.
Yeah, you are right. Okay. So now let's take the 27,600 minus 9,400.
Is it 18,200?
It is. All right. So that's basically what we have left for two things: cash flow and debt service. All right. So let's think about this for a second. If we were to go to the bank and get a loan for a non-owner occupied property, what more than likely would we have to do?
Put 20% down.
Yeah. Okay. So let's say we put down 80,000. Okay. Which is just about 20%. So we're going to finance 300. So 300,000 present value. What do you think interest rate wise right now?
I think it's like 4%. I actually talked to a loan officer the other day.
It's non-owner or owner occupied?
Owner occupied. So I guess this is a duplex. So maybe it would be a little less. Like
It'd probably be a little more if it's non-owner, if
Like
owner occupied.
4.5 to 5.
Yeah, probably. But let's just use 4%. Okay. Now, normally I'd rather be more conservative than aggressive, but let's just see what that is.
You're in the aggressive mood.
Let's just see if these numbers work, right? So, so the payment would be $1,432 a month.
Okay.
Let's do 1,432 times 12.
It's not looking great.
It is not. But I remember that you said you like this deal.
That is fair.
So
We'll see.
the payment would be 17,184. So without management, without really any capital expense, which that you can get away with is a duplex, you are going to hopefully make $1,016 for the year. Cody, how do we calculate our cash on cash return?
Oh man, I know, but I'm on the spot. Basically, how much you bring in divided by how much money you're putting into the property. So probably repairs plus
so the 1,016 will be our net, right?
Yep.
So 1,016 divided by $80,000 down payment.
What do we do? 90 to add in repairs?
I'm not even going to talk. We're not even worried about repairs. Okay.
All right. How bad is it?
1.3% cash on cash return.
That's ugly.
That is right. As an investor, I would hope we could find something better than this, right? Because not only are you paying retail, you're overpaying, right? I mean, that's pretty poor. Pretty poor to put $80,000 down to generate 1,000. And do you really want to own a property, putting $80,000 down to hope to get $1,000 back a month? And we only budgeted repairs are $1,500 for the year. A furnace and air conditioning, a roof, semi problem with plumbing, electrical, sewer, on and on and on, wipes out our whole cash flow for the year, maybe a couple 3 years, right? So what could we do? We could pass, or let's try to get creative here. Okay.
Yeah, because that's what bank financing, right? All that was.
Yep. That would be bank financing, which tells me right off the bat, what does it tell me? Either the seller's asking too much, or it tells me that the rents are too low and somehow need to be raised. It's pretty much one of those two things, right? If we're putting down 20%, we should be able to make some kind of cash flow that makes sense, right? This one is not. And this is the kind of deal that we run into a lot these days, right? This is more the norm than the exception right now. All right, so using our hybrid interest rate, what if we decided, so this seller said, yeah, they'd be open to terms, and they don't necessarily need like a huge down payment, because those are first and foremost. And let's just pretend that this property is free and clear, right? Okay. So what if we came in and said, look, we'll pay you maybe not the 385, we'll pay you 375. Could we pay the 385 if we wanted to? We probably could. Price doesn't really matter as much, but I also don't want to overpay for the sake. I still think 375 is an excellent price for this property. Would you guys agree? I don't think it would change anything in terms of our numbers if you went conventional. 20% is still going to be 75 grand. You're still financing 300,000, right? So we're just not overpaying by as much as we would have at 385. What's a good down payment? What do you think, Cody?
I love a good 5% down payment. It's about 15 to 20.
Okay, so this is a rental property, and yeah, I'm with you. If I can get in for 3 or 5% down, I would love to. But let's say we can't. Could we offer 10%?
Yeah, for a rental.
Let's say 35 down. Okay, so now in this case, we would be financing 340, right? So if we're paying anywhere near bank rates, and I'm pretty clear that 4% would be on the low side of that right now, right? We've got a payment that is not going to work to create any kind of cash flow, correct? So this is where we need to get creative. So why don't we offer an interest rate of, Nicole, take a guess. What should it be?
The 4%?
No.
3.5?
No.
I don't know.
Think hybrid interest rate.
2.5?
There you go. Let's try 2.5. Okay. And we're just winging this right now, right? I haven't figured this out. But this is what you go through to determine if offers will work. Now, granted, I know where I want to go with this, right? So, um, uh, I'm already, is the price negotiable? It might be. Is the down payment negotiable? Maybe. But I feel like, hey, based on where we're at price wise, we're still offering a very competitive price. And hey, the down payment is kind of a potential deal breaker for us. If it gets too big, we're out. Especially too big when you're asking too much, right? So, hey, if we're around that 10%, I think that's pretty good. So now the rest has to kind of favor us, right? So maybe interest rate needs to be 2%, but we got to start somewhere. So let's pick a number and see where it takes us. Okay. What we do know is we're financing 340 based on this, right? Let's say 2.5%. So now it comes time to figure out two things: the term and the payment. Okay. So we figured out that before, at interest rate of 4%, 1432 is too much, right? So what if we were to only be able to pay this seller $1,000 a month, which would mean that 432 is no longer part of debt service. It's now part of that yearly, the net cash flow, the $1,000. This 432 is monthly, so we would have to times it by 12, right? So that's going to be about $5,000. So now all of a sudden cash flow would be around $6,000. And if we're putting down $35,000, Cody, what's 6,000 divided by 35?
I should do it in my head. I feel like that's what you're expecting.
I was not.
Straight to the calculator. About 17%.
Is that a better cash on cash return than
1.
1.3.
right, than 1.3? All right, so
Yeah.
that seems like that's about where we would need to be. Maybe with some leeway, but so now let's figure out what that means, right? But where is it going to put us with where we need to be term wise, so that we can, when it comes time for a balloon payment, that hey, we're not totally upside down and we can't refinance this property. So let's put 340 as present value, 2.5 interest rate, and let's put 48 months, and let's put $1,000 negative as payment, and see where that takes us. So it takes us down to 325, which isn't bad, but what does that equate to? It's 15,000 over 4 years. It's about $3,800 a year.
Yeah.
Nothing super exciting. However, when our payment's only $1,000 a month, there's only so much money that can go toward principal, right? So why don't we do this? Let's reduce our interest rate from 2.5 to 2. Okay. And let's add $100 to our payment. That's not going to kill us. It's not ideal, but it's not going to kill us. And let's look at maybe reducing our principal balance by, let's say, $7,000. So let's make our present value 333. And we can do that in a couple of ways, can't we? We could just drop the price that we're offering, or we could add more to our down payment. But here's what I don't want to do. If we were getting 17% cash on cash return, if I'm upping the down payment and I'm giving away some of the cash flow, that is going to significantly alter the cash on cash return. So more than likely, I'm going to just reduce the price. Okay. But now let's see where this takes us, Cody. What do we get? 305. So that's getting a
305,
little better.
788.
Okay. So if we really believe that this property is worth 380, then we would want to make sure that whatever balloon we give for ourselves, that we're going to be under 80%, right? So that means that we don't have to bring any more money to the table when our balloon comes due. And chances are, if we were close, that there would be some appreciation, but I don't want to rely on appreciation. I want to know that, hey, when we get to that point, that we're good. So if you go back to your calculator real quick, so we're at 305, maybe 306. So let's add one more year to our term.
Okay.
So let's make it 60. And all right, so now we're at 298. So we're under that 300. And, given 5 years, it's probably going to appreciate some, that would probably be okay. So now, but let's say that we have an offer of, so initially we were at 375, right?
Mhm.
So now we're at 368 because we're just going to reduce our offer by $7,000. So 368. We'll still keep our $35,000 down payment. We're going to have an $1,100 a month payment, an interest rate of 2% for 60 months. And that is, let's see if that still makes sense. So 1,100 times 12 would be 13,200 instead of the 17,184. So that would increase 13 to, so it's about a 4. So we'd make about $5,000 a month cash flow. So about a $400 a month cash flow. So let's say 5,000 divided by 35,000 is still a 14.3% cash on cash return. So that, I think we just found our sweet spot. I don't think we can really offer any more of a payment. Now, if let's say that we thought that the rents were $250 too low. So we feel like we're going to get some of that added benefit. That's okay. Maybe we could go, hey, if we thought we could raise it 200, maybe we could go 1150, 1175, but we don't want to offer what the future, the bonus, the upside is. We don't really want to offer it to the seller. That kind of defeats the purpose, right? So if we can buy this and we're let's say going to get a $5,000 a year cash flow, but we could also increase the rents by 200. Now we're going to get $7,400 a year cash flow, which only makes this deal better for us. So this is a way. Do you see now, Nicole? Before the payment, going to a bank is going to be $1,432, which is at least $320 $300 too high for us, right?
Right.
I'm just curious too, if we take that, so we had to put 80 grand down and we're paying 1432. In our example, we're putting $35,000 down, not even half of that, and our payment is 1,100. Okay, that's what we have to do on some of these income properties these days to make them work. Otherwise, guess what? You have to put down 20, 25, 30% to make these deals work. And so if that's what you want to do, which defeats the whole purpose of income property, right? Because the more money you put down, the less your cash on cash return is going to be. And if you can't get a good cash on cash return, then to me, it's like, move on, find something else that will better fit. But you see how we can modify the interest rate and the payment and the term for that matter to fit with what this property can afford. And that's exactly, and if I presented this offer and the seller said, well, I don't really want a 60-month term. I'd probably go 3 years, but not 5. I would just say, look, the whole goal is to make sure that we can refinance so we can pay you off at the end of the term. At the end of 3 years, we'd have to come with more money. And who knows what the market's going to be like and what interest rates are going to look like. You do want me to be able to refinance and pay you off, right? So to be sure about that, we're going to need a longer term. Well, you're only paying me 2% interest, and that doesn't amount to much. Still more than what they're probably getting if they're leaving their bank in a savings account in a short-term CD. 2% still better than that. And by the way, if this was a free and clear property, let's see, what are they going to net? 1,100 times 60. They're going to get 60 payments of $1,100. They're going to have their balloon payment of where is that?
I don't think we calculated that.
The 298.
298.
Oh, yeah.
639. Whoops. So 1,100 times 60 plus 298, 639 plus 35 that we gave as a down payment. So they're making $399,639 for the property over 5 years. So they're over and above what they were asking. They're probably taking less, although not a ton less than they were probably making after expenses, right? They have to pay the same expenses we would, and that's about 10 grand. So they were making 26,000, they're making 1,300 a month maybe. So now it's 11, but they don't have anything more to do with it. They don't have to worry about fixing the roof or the furnace or whatever else. And now that they've got they're making money on their money, they're getting a good price for their property, and they don't have to deal with all the headaches of being a landlord. Does that make sense?
Mm-hmm.
Yeah.
You see why it's important to understand how to use the hybrid interest rate, because otherwise this deal sucked.
Well, it wasn't really a deal.
It really
to
was
begin with.
not, right?
Yeah.
Wait till you see the next one. Even less of a deal. So, but really common. Okay. So, all right. Any last words, and we'll wrap this up.
No, I think I'm good.
For me.
Okay. So if you're interested in learning more about creative financing, certainly go to our Facebook group. Watch out for our live event that we do once a month on the second Thursday of the month. The Facebook group's great. Ask your questions, bring your deals. A lot of smart people in that group. If you want to know more about our Creative Financing Academy, just reach out to me. Or if you'd like the free video that we will send to you, let me know. Happy to do it. Everyone has really enjoyed the free video. And of course, we have an apprentice program where we work with newer investors, teach them what we do. We work nationwide, virtually, and wholesaling, commercial, notes, all the different kinds of things that you will find super cool. Reach out to me or Rebecca at weofferoptions.com. Did you guys like this episode? Are you getting more comfortable with the hybrid interest rate?
Yeah, with the more examples that you're giving, the more it's starting to make sense to me.
Good.
Yeah.
Awesome.
Super helpful as always.
Good. All right. Well, go out and create some terms. Till next time.